Recall from the recap how the increased economic growth of major players in the Middle East and Asia contributed to the growth of savings not just in these countries, but also to the giant pool of savings. Well, today in this podcast, we'll be looking specifically at how the growth in China and the Chinese currency, the renminbi's close link to the dollar may have contributed in part to the current economic crisis. This increased savings in China fueled a housing boom in the United States. But how did that happen? How did this transfer work, and what does it all mean? Well, to first understand this, we need to take out the American family and look at the equation from the start. In the beginning, a Chinese family would take their money and give it to some investor, and the investor would go and put it into a major fund. Those funds would become part of the giant pool of money, and that money would be given to investment banks and Fannie and Freddie, and these organizations would channel that money to buy mortgages from commercial banks who had gotten them from American families. What makes this story between China and the United States a little more interesting is their trade relationship. When the United States makes a good and sells it, it's called an export. On the other hand, when the United States buys a good from another nation, it's called an import. Trade is balanced between these two countries when Americans are buying the same amount of goods from the Chinese as Chinese people are buying from the United States. When this occurs, both sides are getting an equal amount of goods, and no side is indebted to the other. In reality, Chinese goods were very, very cheap, and because they were cheap, there was a huge demand for them in the United States, more so than there was a demand for American goods. The result of this huge demand was that Americans were buying more Chinese goods than Chinese people were buying of American goods, causing the United States to enter a trade deficit with China. This desire to buy a lot of Chinese goods represented a larger problem in the United States: overconsumption and lack of savings. In fact, since the 1980s, Americans have not been saving enough. The amount of disposable income, that's the money that you earn once you've paid your taxes, has dropped significantly. Up until the recession, it was less than 1%. Now, we know that savings is important because unless we save, how are we able to afford things? Well, in economics, savings was not just important, it was a necessity. In most basic macroeconomics textbooks, there was this idea that savings should equal investment at all times, and if they didn't, interest rates would change to balance everything out. It's important to note that investment in a macroeconomic sense is not the same as investment in a stock market sense. Instead, investment refers to purchasing products such as capital goods, which are essentially things like when a company invests in a factory or plant. That's money that they're not saving. So savings and investment has this inverse relationship. Let's assume investment is too high and savings is too low. Well, interest rates would rise. This would make it more expensive to take out a loan. Demand for borrowing would decline, as would investment. With higher interest rates, people would want to purchase interest-related products such as T-bills and bonds. Savings would therefore increase. Theoretically, the difference in investment and savings would balance out. On the other hand, if savings was too high and investment too low, interest rates would come down. With lower interest rates, people are more inclined to borrow, investment comes up, but return on interest correlated financial products such as T-bills and bonds are now lower, so people are less inclined to purchase them. Thus, savings would come down, and once again it would theoretically balance out. Well, fast forward to 2000, and we're experiencing relatively high interest rates, but savings hasn't come up. Why is that? Well, it had to do with changes in the world economy. Back in the day, the money that a person earned in one country could only be saved and invested in their own country. These restrictions on investing money in other parts of the world was called capital controls. While in the 1970s and 80s, a lot of countries began removing these capital controls, allowing free flow of capital. In many cases, it allowed a lot of developed countries to pour investments in capital into developing regions. But on the other side, there was a lot of money coming from countries like China and flooding the markets in the United States. Economist and current Federal Reserve Chairman Ben Bernanke argued in his theory, The Global Savings Glut, that it was this inflow of Chinese savings that provided a boost to crucial American markets, such as the stock market. Furthermore, the high demand among Chinese investment for treasury bills and bonds at low interest rates helped keep interest low. This, in effect, played a role in fueling consumption, especially in the housing market. And even though American savings were still low despite high interest rates, these low savings were as a result sustainable due to the fact that global savings was filling this void. To review, the United States had a huge trade deficit with China. It also has a huge problem with saving. The liberalizing of capital flows, or enabling people and countries to move their money, global savings, anywhere, fueled American consumption, also known as the global savings glut.
Coming up, we will learn how China's exchange rate and high savings may have contributed to the crisis.
Thanks for watching. To learn more or watch more podcasts, visit www.subprimethemusical.wordpress.com.